Hi, this is Alessio, Rastani, the trader. Hope you're well. In this video, we're going to take a look at the mother of all bubbles and whether this bubble is about to pop and potentially collapse. And in case you're wondering, yes, I'm talking about the property market or the real estate market. In fact, what I'm going to show you in this video, you can apply it to other cities, other countries. And I'm also going to show you some interesting techniques you can use to find out when is a good time, for example, to buy a property and what potential dangers or mistakes you can avoid when buying a property. And let me just say this, that even if your main focus right now is not real estate or property, if you're interested, for example, in something else like stocks or crypto market, something else, I would highly recommend you still watch this video because chances are you may want to buy a property at some time in the future, and this video will be very important and useful to you as a result. Now, let's begin by taking a look at this chart that you're seeing here. And in case you're wondering, this data was provided by UBS, one of the biggest financial firms in the world. And according to their research, what they've done is they've indexed a number of different cities, some of the key cities around the world. Now, take a look at these cities and ask yourself whether you live in one of these cities right now. And the ones in red, so what you see here, the ones that are shown to you in red here are the cities that are most at risk of being in a property bubble. All right, so the highest on this index, interestingly, is Toronto. Then you got Stockholm, Munich, and here's the city that I live in, which is London. We'll take a look at this in a few moments. And down this list, by the way, as you can see here in yellow, these are countries or cities, I should say, that are considered overvalued by this index. So Paris, San Francisco, Los Angeles, Zurich, and so on and so on. Then in the green section here, you can see we've got Boston, Singapore. That's the green ones are considered to be fair valued. I have to say, though, I was quite surprised to see New York here in the fair valued section. I don't really understand why that is. But anyway, Chicago, by the way, is by far has been found to be the most undervalued, undervalued city here on this particular research and index, which is, again, very curious and interesting. So what I'm going to do, guys, in this video is I'm going to use London as an example, purely because I myself am looking to buy a property in London at the moment. Again, even though I'm going to use London as an example, you can use some of the methods and techniques I'm going to show you in this video to apply to other cities and countries as well. So some of these techniques can be transferred to other cities. Now, according to some research done by the University of Lancaster, here's what they found. They said that London is on the cusp of a housing bubble, which could ripple out to surrounding regions, according to this research. And they also said, according to this report, historical evidence suggests that phases of exuberant house prices are often followed by a sudden crash, leaving homebuyers with large mortgages and negative equity. Now, this research from the University of Lancaster was done about a few years ago in 2015, and they said that London is on the verge of going into a bubble, and they said that this bubble could potentially collapse by 2017. In fact, as you can see here, they said while Britain is not in a bubble, but London is on the cusp of one, and it could blow up in 2017. Now, that research from the University of Lancaster certainly corroborates with what UBS found. Again, they said that London is certainly among one of the cities, I should say, that is in a bubble. Now, there's a very interesting article written by Property Geek, which I think is worth reading, certainly. It's very fascinating. And in this particular article, here's what this gentleman says. He says, would I buy in London right now? Absolutely not. Even if I believe that prices are just going to go up forever, which I don't, they're already at such a level that an investment doesn't make sense. Stress test at higher interest rates, and there's no way of making a respectable monthly return. I totally agree with that because having myself been looking for properties here in London, the yields that you can get in London are just ridiculously small. Okay, so the next thing you want to do is pull up the actual price charts of the sales of properties in your area or in your city or country. Now, if you live in London, you can actually go on a website called landregistry.gov.uk. Very fascinating and very interesting website. Again, that's if you live in the UK or in London. If you live elsewhere in the US or other countries around the world, then you want to find out where property prices are listed and you want to actually pull them up and find them like I've got here. So for example, I've got the price of properties going back to the year 2000 and that's all I need for the moment. And actually it gives me a lot of information which I can work on. And I'm going to show you some statistical methods that we can use here to find out what the actual charts are telling us and how we can use this to our advantage. Now, what you see here on my chart are the actual house prices in London for the last 20 years. So there's no guesswork here. These are pure facts, pure data, and that's what we want. And by the way, the purple line here are all the house prices. So basically properties everywhere in London. all kinds of properties. And the orange line here shows to us just the prices of flats and maisonettes. And the reason I put the orange line there is because flats are usually the kind of properties that investors want to buy, for example, for a buy to let. And it's the kind of property I myself also am interested in. But again, let's just for the moment focus on the purple line, which is all property types in London. Now, what you want to do here, the first thing you want to do here on the chart, especially for those of you who may be new to chart analysis, is you want to identify, and actually I'm using Microsoft Paint here, and some people don't like Microsoft Paint. I find it very useful. I love Microsoft Paint. It's very easy and simple to use. And all I want you to do here is, first of all, identify the peaks. I'm just going to mark them on my chart, the peaks on the chart. So I'm going to label that black, and there's another peak there. All right. And also, if you can, identify the bottoms on the chart as well. So bottoms or troughs, the most significant ones there. I'm just going to put that there as well. And also maybe this bottom here as well. There we go. Okay, the next thing we're going to do is we're going to grab a line. I'm just going to connect the tops like so. And it doesn't have to be perfect, but just going to try and connect these tops like so. All right. There's that. And then draw a second line parallel to that, very close to it, parallel like that. All right, and I'm going to show you what we're going to do with this second line. Okay, as you can see, it's parallel, and then I'm going to drag that, just drag it, and put it at a level here so we can get, at least connect two data points. I'm going to put it right there. We're going to connect those two bottoms right there, like so. Okay, there we go. All right, so that's what we got. What we got here is a channel. And many statisticians use these kind of channels to identify support and resistance and also find the mean average. So the next thing we're going to do here is find the mean average. And how we're going to do that is very simple. We're just going to grab another color and grab a line, and we're going to draw a parallel line right in between these two red lines. Should not be very difficult, should be very simple to do. Okay? All right, there we go. And that appears to be right in between by the looks of it. And as you can see here, I'm not using any kind of sophisticated chart software because most chart softwares obviously don't have London house prices on them. So we had to really create our own statistical tools. All right, guys, so now I've removed those circles on my chart so we can see the chart and London house prices much more clearly. Now, one of the most important concepts in price analysis or chart analysis is what's called regression to the mean or reversion to the mean. Now, quite simply explained, this is the pattern of behavior of price that whenever price gets far away from its mean average, it tends to come back like a kind of an elastic band. When an elastic band gets stretched, price usually likes to come back to its mean average, to its average price. Now, if you look at this chart, you can very quickly and easily identify where the average or the mean average price is for London properties, because we've already done this. As you can see, that green line you see on my chart, that is now the mean average for London house prices, okay, or London properties. And that puts it where? Well, here's the thing. The peak, the most recent peak for London house prices, very close to 500,000. 500,000 or 500,000 was the average house prices not very long ago, about a year or so ago. And as we can see, since that peak, prices have actually been falling. In fact, if you speak to many real estate agents or mortgage brokers in London, they'll tell you the same thing, that either prices have been stalling, going sideways, or have been dropping in certain areas. But certainly in London, from what I've found, is that the average price has been falling or has been flatlining. Visually, you can see that prices seem to be making this kind of reversion back to the mean, back to this green line you see here, our mean average line there. And by the way, the mean average line puts it more or less at the, well, put it this way, depending on the strength or the speed of that move. If it comes down much more faster, we're looking at potentially 450,000 to maybe 460,000 as the mean average on London properties. Now, here's the thing. If it goes through that mean average, I mean, that's the question. What if prices keep falling? We can quickly identify also on our chart where the next major support level is for London properties. In other words, if prices keep falling for the rest of this year, going to next year, we can potentially identify where they may stall and where they might come to a stop, which is at the bottom of that channel right there. And that puts it where? That puts it more or less at 430,000. So what we can learn from this chart is that we've identified the mean average price for property prices in London and also where they may be potentially undervalued or fair valued. I think certainly Anything from the mean average to below the mean average can be considered as fair value or undervalued. But the slope of this particular price chart tells me that it's very likely that we're starting to move down lower to at least test this mean average. Again, remember, one of the key concepts in price analysis is regression to the mean. The fact that price often likes to pull back to its mean average. And I think that's what's happening right now. Now, there's one more important thing you can do here, which is you can pull up the chart of one of the major real estate firms in your area, in your city or your country, and look at the stock price of that real estate firm. Now, I've personally chosen Savills in London because they are a major real estate firm in London. And here's another reason, because their prices, their stock prices, predicted the last major property crash that occurred in London. What you see here is what happened to Savills right before the major housing crash and the financial crash we had in the year 2007 going to 2008. And Savills back at the time was giving us a major warning signal about house prices in the UK and also in London. You see, here's what happened in the year 2007. Up until 2007, house prices were skyrocketing here in the UK and actually many places around the world as well. But especially in London and in the UK, house prices were just skyrocketing. And you can see it made a peak right here, right there. That's the closing price of Savills. The closing price of Savills was at $690 in the year 2007. Then what happens is it had a drop and then it tries to make a new high. Look at that. It tries to make a new high, break through that closing price. And what happens? It fails. It fails to make a new high. Look what happened. Immediately after that peak, it then collapsed and starts falling. In technical analysis or chart analysis, that is called a false breakout. And a false breakout of a major resistance level like that is essentially a major sell signal, especially if that false breakout is accompanied by another signal called a negative divergence. Look at that. That is a negative divergence signal right after a false breakout or before a false breakout. So what do we have here? We have a failed rally, false breakout, accompanied by negative divergence, and we had a pulse signal that fired short. This was a major predictor of a house price crash in the UK. Now, take a look on the price of Savills right now. Do we see any kind of similar scenario to what's happening? I would say perhaps yes. For example, we can see that up until the year 2015, there was a major rally in house prices here in the UK, peaked in 2015. Now look what happens next. It has a correction, then it tries to go back, tries to make a new high, in other words, make a new high based on the closing price, and it fails, or at least certainly it has not managed to break through successfully above that high. And currently it's actually below resistance. What else do we have here? Well, we have a pulse signal, which means a potentially big move could be happening soon, a powerful momentum move, and we have negative divergence. Very similar situation to what we had back in the year 2007. And if it breaks these lows, and especially if it breaks these lows, because that's breaking market structure. So if we see something like this happening here on Savills, so heading down, again, breaking support, that certainly would be a very bad sign for the housing market in the UK, because this essentially is a predictor of a major potential fall in house prices. My conclusion, based on what I've found and what I've looked at for you in this video, tells me that it may not be a great time, or indeed a safe time, to buy a property in London. I certainly would think that this data here from UBS is correct. It certainly does seem that London has been overheated, perhaps rather overvalued, and we would need to see some kind of regression to the mean, some kind of reversion to the mean before we can find those fair value or undervalued properties in London. And guys, please do me a favor. If you found this video to be helpful or interesting, please give it a thumbs up. And also please remember to subscribe to our videos for future updates and videos. Thanks very much indeed.